Let's start this session on a very important Indian financial systems. It is the structure of the financial systems in India, how it will look like, and what are the key pillars in the financial systems, like the financial institutions, financial market, financial instrument, and the financial structure are in Indian financial system. So we are going in detail in this video. Guys, if you think it is a system, it is a financial system which will be the part of finance, and you should think how the finance will work, like what are how the different organizations or different industries or different companies are involved in the financial systems. So financial system is a very huge and large system. There is a NBFCs, banking, mutual fund organizations, or the brokers, SEBI, all these things involved into the financial system, and how they are different from the banks or NBFCs, and what are their roles and responsibilities to serve the Indian financial system. So we are going to touch this point in this video, and I will help you to how to understand the Indian financial system, what are the key pillars in the financial system, what are the key organizations, what are the instruments that are created in the Indian financial system. So let's first discuss on the objective of this video, guys. So I will help you to understand or help you to understand the structure, the participants, institutions, market, instrument, and the regulators that are involved in the Indian financial systems, and how they differ from each other, and what are the roles and responsibilities they are playing for Indian infrastructure systems. We are going to look all these points in the entire series of the videos. So, their role is like a liquidity management, like net stable funding ratio, or or the liquidity coverage ratio management, or they do the capital allocations, the risk transfer, treasury operation, finance and stability, and the institution like FIMMDA, RBI, Treasury perspective, how they work and help the Indian financial systems to monitor, track the Indian financial system. So that's the objective of the Indian financial system. So to understand, so in this video, guys, we are at the key concepts like the financial intermediations, how they are involvement, how the each financial institutions will interact with each other, how they play their roles, and then financial market, like the derivative market, equity market, commercial product markets, how these markets are involvement, money market, okay, how they are involved. Then the financial institutions like bank, NBFCs, or the RBI, SEBI, these are the financial institutions, or the financial instruments, commercial paper, deposits, fixed deposits, equity. So how these are the products involved. Then financial infrastructure, how they pay the crucial roles. Then money market, capital market, banking, non-banking payment, settlement, RBI regulations, treasury, AML functions. So these are the key concepts. You should understand, guys, these concepts in details if you want to pursue your career in the financial market. So let's move on the details content for this. So first, understand the definitions of the financial market, and then we will move to the next thing. So a financial system is a network of institutions, instrument, and services that facilitates the transfer fund from surplus to say deficit fund. So the Indian financial system is a platform, or it is the system, or it is a structure created ecosystems where we are collecting, or the sources of funds which have the saver or the surplus funds to the deficits, or the borrower wants to funds to understand their financial objective. So that's the ecosystem, that's interactly involvement, where we are going to sources of funds from the pension funds, or the deposits, banking deposits, or the mutual funds, and invest in the lending to that funds to the borrower or the commercial banks, to the corporate bonds, or papers, commercial papers, to invest that fund. So that's we do in the financial system. So that's the definitions of the financial system. Then the components of the Indian financial system. So there are majorly more more components. More four components is financial institutions, financial market, financial institutions, and the financial infrastructure. So in financial institutions, where involvement of the RBI, Reserve Bank of India, which is the regulatory of the banking institutions of India. Then the commercial bank like the commercial banks like the SBI, Kotak Mahindra, Union Bank, or the HDFC Bank. Then the cooperative bank. So the cooperative banks is there. Then the NBFCs, non-banking financial institutions is there. Then the insurance companies, mutual funds, or the pension funds companies. These are all the financial institutions that will how the financial market like money market, government security market, foreign exchange market, derivative market, or the capital market. These are the financial market where the financial instruments are traded, where the buyer will buy the product, seller will sell. This is the financial institution. So the market is a place where the buyer will sell their product, and the buyer will buy the product and seller will sell their products. Then the financial instruments, that instrument will traded in the financial market with by the financial institutions. So like deposit, commercial paper, commercial deposits, treasury bills, government securities, corporate bond, interest rates, swaps, FRA, and the currency derivative. All these financial instruments are traded in the financial market by the financial institutions and the infrastructure like Clearing Corporation of India Limited, NDS Operation Management, RTGS, NEFT, UPI, and the clearing, housing, and the deposit. So these are the financial infrastructures that involvement. Guys, recently comes news from the financial infrastructure. So then the segmentation. So there are the more two segmentations. First one is the money market, and second one is the corporate market, or the capital market. So in the money market, where the financial instruments which are traded for less than 1 year, so that all comes under the money market. And the capital market, where the financial instruments that traded in the market which has more than 1 year. So like the TREPS, call money, treasury bills, commercial paper, certificate of deposits. These all are the short-term financial instruments which are traded for more than less than 1 year. And the capital market are the instruments which are traded for more than 1 year, like the government securities, state development loans, SDLs, and the corporate bonds and equity. All these are the long-term financial instruments which are traded for more than 1 year. So let's move on the next slide where we discuss on the flow of funds, how the funds flow will happen for in the financial market, like the household or the depositors will deposit their funds in the mutual fund or the banks. Then bank will that pool of the funds and that invest into the financial market, or to give that to the financial market. Then government or the corporate, and then that utilize that funds. Then surplus fund, the savings, the deficit sectors raise the funds from investment and the growth. So I will give you the practical example of how the fund flow will happen. So if suppose there is the one bank, NAFID, National Bank for Infrastructure Financing and Development. So they are invest their fund in the infrastructure fund. So how the fund flow will happen there? So they will sources of funds from the external commercial borrowing, mutual funds. They are sources funds from the pension funds or the insurance funds, and that the funds are getting collected from them, and then they will do their mechanism, risk management technology. That they create the insurance, they create the bonds, they collect the funds from bonds, and then they will lend that fund to the Indian infrastructure projects like the road construction, rail construction, airport construction, metro road construction, water renewable management, state development funds, or These all the where they invest that fund, and then that fund will get, and they monitor, manage that entire fund, and then they recover that fund in the form of the principal and the interest rate, and then they will do their analysis. They net interest margin, they will take their funds and then back to that funds where they borrow these funds. So that's the fund flow will happen in the financial market, and there are different industries, different organizational are involved to that entire journey. Then the role of treasury, so managing the liquidity, it is the important role of the liquidity to manage the asset liabilities in the liquidity market. Then the managing the statutory liquidity or non-statutory liquidity securities, then managing the interest rate risks and the market risks, how the interest rates will evolve, how they are impacted on the balance sheets, how they are impacted on the flow of the funds, and how the market risks, how the market factors, where the equity prices, the commercial commodity prices, or the interest rates, or the fixed income, or the yield curve are changes on the prices of the market. So that will consider in the market risk factor and how to manage that entire thing. Then the funding and the balance sheets optimizations, they do how the next 30 days or the 1 year funding they need to require, what are the sources of funds, how to manage. So that's all these done in the role of the treasury. Then the importance, how the this financial ecosystem is important. So promote the economic growth, it is the key part to grow the economics, to collect the funds from the saver and deposit in the deposit funds, then enhance the monetary policy transmission, support the efficiency treasury, and the facilitate the risk management derivative. So they will facilitate the risk management derivative in financial market. Then the next, the core market infrastructure. So what are the core things that are contained in the infrastructure market in the financial ecosystems, or which are the part of the structure of the financial system. So first one is the CCIL, Clearing Corporation of India Limited. So it's provide the clearing and the settlement for all kind of the funds. Then NDS and the operation management facilitate the electronic funds in of G6, and the TREPS enable the collateralized or night borrowing and the lending, and RTGS so ensure the real-time settlement of high value transactions. So let's move on the main which is how we look like the FIMMDA perspective of the Indian in structure of the financial system. So FIMMDA standardized the valuation and market convention of fixed income and money market instruments. So FIMMDA play in the important role of fixed income and the money market instrument, how their standardization, their valuation, market convention, and and it provide the benchmark for the G6, SDLs, SDLCs, and the corporate bond, commercial deposit, commercial papers funds. So issues the guidelines on the yield convention, day count convention, price yield calculation, mark to market methodology. So they will issue the guidelines for these the analysis and support the uniform valuation across the treasury bonds, and work closely with RBI market participants and the Clearing Corporation of India to improve the market practice, to help how the market will on to the mark. So the important formulas you should understand for the yield is coupon, face value, price, year, and the face value plus price. So we will look these all in the fixed income lecture, guys. You should understand just the FIMMDA perspective and how the FIMMDA do the yield convergence, day count convergence, and yield calculation and mark to market methodologies, and this formula just keep in remember. We will going to discuss in these the derivative sections. So then the RBI logo regulatory perspective. So in this where we are going to look at the functions of RBI, regulatory objective, then the important tools that will use by RBI, and that all these we are going to look at in detail, and the market oversights. So RBI functions will be the the monetary policy authority. Yeah, it will have rights to issue the monitor, and it will monitor the monetary policies, issue the notes in the market to track the monetary, to optimize the monetary, to make sure the circulation of funds will happen correctly. Then the regulator of the banking system. So it will be regulator to define the regulators of to implement the Basel norms in the Indian banking financial system, to do to track the regulations of the banking of Indian banking, to do the market risks, liquidity risks, operation risks, or the market risks, liquidity risks, operation risks, and the credit risk calculations or their methodologies. And now recently expected credit loss mechanism are implemented. So to implement that the system in the Indian banking financial system, then the debt manager for the government, to provide the government funds, to manage the debt funds for the government, regulatory for the money market and the government securities, to money market product regulators and the government securities, and the oversight payment and the settlements done by the RBIs. And then the regulatory objectives of the RBI: financial stability, market development, liquidity management, consumer protection, and the system risk mitigations. These are the important the regulatory objective which is done by the RBI. Then the important tools, RBI tools that used by the RBI. So repo rate, you should understand the repo rate. We will go going to the charge which will done by the interest rate, that is objective by the savings for the investment done in the RBI funds that pay to the RBI to the banks, and the reverse repo rate, the CCR, liquidity coverage ratio, and the open market operations, variable rate, repo markets, stabilization scheme. So all these things we will go specifically discuss in detail in the RBI related sections which we created in the upcoming slides, upcoming videos. And the market oversights, NDS-OM, clearing corporation of India, TREPS, forex market, derivative market. So that's the regulator of RBI, and track and progress their perspective in the RBI. So let's discuss on the treasury perspective, how the financial system will involve in the treasury perspective. So front office, back office, treasury objective, and mid office. In the front office, we will do the trading of the G6, SDLCs, and the corporate bond, money market, or the market borrowing, lending, TREPS, participant, forex, and derivatives. So all these things in the front or will happen. It comes under the front office operation. Then the mid office, we will do the market risk management, credit risk management, liquidity risk management. We do the duration analysis, value at risk calculations, or the expected short calculation. We do the stress testing, scenario analysis, or the gap analysis we do, and the MDM, mark to market valuations we do in the mid office operation. That will done by the mid office team. And the back office, where the trade confirmation, clearing corporation of India, settlements, accounting, reconciliations, where we reconcile the order and to matches that orders with the reconciliation, and the regulatory reporting, and the treasury objective, liquidity management, profit maximization, risk control, and the regulatory compliance that will do in the treasury objective, where the liquidity management, asset liability management, or to apply the Basel norms, or the Basel three pillars, and the profit maximization, risk control, and the regulatory compliance. So we will on the last slide, we will look at the practical banking example, where how the financial ecosystems or the financial system will involve. Suppose the bank receive the 5,000 crore of deposits in the system. So how they will utilize that funds to generate the maximize profit, or to save the funds appropriately. So the allocation of funds, the CCR maintained with the RBI, then SLR invest in the GSEC and SDLC, corporate lending, retail loan funded, and excess liquidity invested in treasury bills, money market instruments, to do the optimization of funds, or to generate the expected returns from these funds. Then the financial system flow household deposits, bank treasury, G6, government funding, and the market. So these demonstrate how the financial institution makes the infrastructure, regulatory, and together the financial system. So guys, this is the end of the interesting video. If you like my videos, or if you are interested to understand the Indian financial systems, what are the players, or if you are preparing for the financial institutions role, so please do like and subscribe my channel. So I have created videos on this topic. Thank you so much, guys.